Hey trading babes, it's Tori here, and today we will be covering Forex basics. Forex, or foreign exchange, is the global market that allows the exchange of one currency for another one. Big banks such as the Bank of Japan, the Bank of New England are the market makers, and everybody else follows. Everyone else being us, retail traders and other brokerage firms. When trading Forex, you'll notice the instrument will come in a pair, and although there are two parts, imagine them to be an inseparable couple like Summer Walker and London. Let's say you have the pair GBP-JPY, right? Great British Pound versus Japanese Yen. If you buy this pair, you must remember you are buying in comparison to how strong you believe Great British Pound is against Japanese Yen. So a better example for couples may be Scarface versus the Terminator. Essentially, you're buying the first half of the pair while simultaneously selling the second half, and vice versa. So if you were to sell GBP-JPY, you're selling GBP while buying JPY. We'll see how this works. Notice the letters of the currency pair are the letters of the economy you are investing in or divesting in, and the currency name. So example, United States dollar, USD, that's why it's that abbreviation, or Japanese yen. Take that for example. The country's name is Japan and the currency's name is yen, JPY. Speaking of money, because I know that's why you're here, let's talk about how you can make it. So our brokers know that we aren't a huge bank like the Bank of Japan or the Bank of England, so they're kind enough to let us use leverage so we can control large sums of money. This is known as margin trading, aka leveraging our broker's money for a larger position. Leveraging how much you use also refers to lot sizes. I'll give you an example of this. So imagine in the first week of November 2019, you heard from forexfactory.com the trade talks progressed between China and the US. You knew this would create strength in the US dollar and weaken gold because gold is a safe haven commodity when the dollar is doing bad. So if the dollar is strong, gold is down. And due to the excessive selling pressure, big, huge engulfing selling candles in the pair gold USD, you knew the next day that you should place a sell stop after the pair finished consolidating in the Asian session. So you placed your sell stop, and after you seen this move, you were super happy because you want to know why? You caught an 80 pip move. Pips refer to how many points the currency moves. These points have different values based on the number of decimal places shifted. Where does leverage come in? So for every point, your leverage tells you how much that point will be worth. So we had 80 points move, right? That is, we had an 80 pip move, and let's say we use $1 leverage, that's 80 times 1. And there's also, let's say we had $10 lot size or leverage size, that would be 80 times 10, which is 800. Or let's say we had a crazy amount of leverage and we used $1,000 lot size. That's 1,000 times 80, which is 80,000. Now, disclaimer, big wins can also mean there's a chance for a huge loss. So if you went against trend with a huge lot size, the loss could have been unrecoupable. So it's best to use leverage in moderation and proportionate to your account size. To make sure that you have the best probability of a winning trade, you always want to pay attention to fundamental analysis and technical analysis. Fundamental analysis is the news, and technical analysis is price action and the charts. And that's it for the basics, guys. Go ahead and click part 2 where I go more in depth about margin, price action, all those good things. Also, comment, like, and subscribe. See you next time. Bye.